This podcast is brought to you by Customplan Financial Advisors Inc., an independent insurance managing general agency in Canada. FINANCIALPODCAST.ca was developed with one goal in mind: to educate Canadians on important topics that affect their financial well-being and make it readily available to all. We welcome you to plug in and learn with us. If you have questions, please email us at contact@financialpodcast.ca.
Hello, my name is Gary Poyer, and I am your host for the Financial Podcast. Today's topic is the informed investor, and we are fortunate to have with us Rob Hack from Customplan Financial Advisors. Rob is a recognized advisor in his own right, but also works with Customplan on the investment side, overseeing compliance and the processing units in the head office. Rob, welcome to our Financial Podcast.
Thanks, Gary.
Why don't we begin, Rob, by having you tell us a little more about yourself?
All right. Well, I've been in the industry for just over 25 years now. I started with a company that specialized in personal finance for lower to middle income families. And what I quickly learned is that personal finance and financial literacy is something that is sorely lacking out there with Canadians. And as I worked with that organization, I also worked my way up in the compliance chain and helped oversee other advisors and their practices. I got to do a lot of coaching and training. And that's kind of led me to where I am now with Customplan as a branch manager and somebody who's in charge of not only the compliance and the processing, but the training curriculum for a lot of our advisors.
Okay, that sounds like an interesting journey. Oh, Rob, what do you mean by the informed investor?
If there's one life skill that could be taught better and more understandably in our school system, it's personal finance. There are some basics taught in some high school courses, but I'm amazed at reactions of everyday Canadians, whether it's one-on-one or whether it's in a group setting, when I explain some financial fundamentals in everyday English.
Well, I certainly agree with you on that. What are some examples of financial fundamentals?
Well, the very first one that I learned that started opening my eyes over 25 years ago now is something called the Rule of 72. The Rule of 72 will help us approximate the number of years it would take to double a sum of money. Take, for example, somebody who invests at 2%. If you divide the number 2 into 72, you find out that it takes about 36 years for money to double if it's invested at 2%. If we look at 8%, 8 goes into the number 72 9 times. So a sum of money invested at 8% will double every 9 years. So it has such a crazy compounding effect. Take, for example, Betty and Barney, 2 twins. At age 29, each decide to invest $1,000 for their retirement. Well, Barney invests at 2%, so his $1,000 will double once in that 36 years, or at age 65, he is going to have $2,000. Betty decides to do something a little bit different, and she finds a place where she's going to get 8% long-term on her money. Well, her money is going to double every 9 years, or it'll have 4 compounding periods in that same period of time. So it'll double once to $2,000, again to $4,000, and again to $8,000 by age 65.
Wow, that's an incredible difference.
Well, it certainly is. And if we start adding zeros to that $1,000 initial investment, it's 2 different places or 2 different lifestyles at retirement.
Yeah, for sure.
Another example, this is also referred to as the magic of compound interest. It's been referred to as magic. It's been referred to as the most powerful force in the universe, and that's a quote from Einstein. And so I think that people really need to understand how compound interest can work. But this is also where introducing the downside of debt can come in, because of this magic of compound interest can work against us and our financial health when we owe money, whether it's a bank loan or a mortgage or a credit card. The higher the interest rate, the longer it takes to pay off that debt.
Yeah, for sure. It seems like once somebody falls behind in debt, sometimes they even have trouble getting out of debt at all.
That's for sure. It's an entirely different topic, but it's definitely a tough place for people to be and to get out of. There are ways of doing it, and working with an advisor can really help.
Yeah, I've never ever thought of using the rule of 72 in terms of debt, always investments, but it's a good point. What's another financial fundamental?
Well, the saver versus the investor. And this can go back to Betty and Barney. If Barney buys a GIC or a savings account, he's going to have a fixed rate of return, but he's also going to sacrifice, because long term, if somebody has a fixed rate of return at 2% or less, they're not going to keep up with inflation. Whereas an investor can buy a managed investment, something like a mutual fund or a segregated fund, and having that keep up and surpass inflation will actually allow somebody to keep a dollar as a dollar. Do you ever hear somebody say, remember when a dollar was a dollar?
Yeah, for sure.
Well, nowadays we can't buy the same thing for a dollar that we could 20 years ago. And that's not going to stop in the next 20 years. So we need our money to keep up and retain or improve our purchasing power. Another financial fundamental is the word retirement. And I've kind of changed the definition, but how and when can work be optional? Instead of picking a retirement date, when can you have a work optional date? And this is all about, during working years, accumulating income producing assets. If you and I accumulate enough income producing assets, eventually those income producing assets can replace our working income. At that point, work then becomes optional. A lot of people say they love what they do and they want to do it forever. But I tell you, my experience is those thoughts change the older we get.
Yeah, that's the thing. There's lots of things that people want to do besides work. So, being able to not worry about having to work is a big luxury for some people.
That's for sure. And if we accumulate income producing assets, those will continue to pay us indefinitely.
Right. What's another financial fundamental?
One more comes to mind. I've got risk versus return. So this ties in with saver versus investor, because generally the lower the risk, the lower the return. But we need to ask ourselves, what is our definition of risk? Is it losing money or is it running out of money? Because those are two entirely different things. And I think that we have a mindset as Canadians that number one thing is losing money. We don't want to go into a casino because there's a chance we can win, but a bigger chance that we can lose. But as we get older, our real concern becomes running out of money. And so that's why we need to explore becoming an investor instead of a saver. And one way of reducing risk is dollar cost averaging. And basically a dollar cost averager is somebody who invests on a systematic basis in something that can have a variable price, because what that does is it averages out the cost of purchasing so that in the future we can draw out more.
Okay. And dollar cost averaging, does that, maybe you just answered that, but does it actually lower the average cost over time? I guess that's where the term comes from.
Well, that's the idea. It won't necessarily lower the cost, but what it'll do is average the cost. Instead of looking at it in investment terms, look at it for somebody in Canada who decides that they want to go to the US for 6 months. I have a number of snowbird clients now who go down to the States. A lot of them have US dollars on hand, but some of them exchange their money every year. And I always get the question, should I do it this week? Or should I wait for next week? Or we're going in 3 weeks, or should I do it 2 weeks from now? Well, I don't have a crystal ball. But if somebody's going to change, say, $10,000, I'll suggest that they do it 1/3 this week, 1/3 next week, and 1/3 the following week. And that way, we don't have to worry about what happens with the Canadian dollar versus the US. We don't have to worry about anybody twittering the wrong thing on the wrong day and making the financial markets go crazy. If we average the cost, we know that we're going to have a better price throughout the 3-week period.
Well, I tell you, Rob, everything you've said so far makes a lot of sense. Where would a person learn some of these financial fundamentals?
Well, there are plenty of educational resources, as you can well imagine, on the internet. The Government of Canada website has great financial literacy resources. Also, regulators in our industry, they have sites like the Provincial Securities Commission, the Canadian Securities Administrators, and the Mutual Fund Dealers Association. They all have excellent websites that have a section dedicated to financial literacy and consumer resources. I particularly like the investor education section on the MFDA website. There are a number of topics that they cover with links to external partners so that they have a best-in-class explanation on each. I think I admire it because they didn't try to reinvent the wheel. What they did is they just picked the best-in-class explanation and have links to those. But if a person is not research-oriented, I've seen courses offered from time to time in local libraries, rec centers, community colleges. Many consumers learn that road mapping the financial future is quite an undertaking, and at that point they consider an advisor, either through their bank or the independent channel to help them through the process.
Right. Well, Rob, as you know, we're coming up to the busy RSP season, and there's going to be a lot of financial advisors and financial planners trying to get a person to become their client. How would you recommend a person select an advisor?
Well, I'd suggest finding an advisor through referral, an advisor who uses an educational process. Now, this should be a referral from a friend or maybe a family member or a work colleague who has their stuff together. And when I say stuff, I'm doing air quotes. Just like we should steer away from health advice from someone who seems to always be sick, we should not likely take financial advice from someone who is in a worse financial shape than we are. So when selecting an advisor, it can make great sense to interview 2 or 3 before making the commitment to just one. I think a person needs to feel more than just comfortable with their advisor, because it should be and will likely be a long-term relationship. So the regulator websites that I mentioned earlier, these provincial securities commissions and the Canadian Securities Administrators and the MFDA, they also give some great advice on this topic, because it's important to check licensing status and discipline history before selecting an advisor.
Right. Yeah, speaking of discipline, from time to time we hear about investors falling victim to fraud. How does a person know if they're choosing the right person or firm?
Great question. That's it's a tough one. I think that the regulators in this industry do a great job of providing resources so that consumers can protect themselves by doing their own homework before they decide to invest. Not only are there step-by-step guidelines on their respective websites, but I've seen TV and print ads that point to this also. One series of these ads, it raises awareness about the possibility of fraudulent activity and where a person can start researching to protect him or herself. The ads are an eye-opener for sure. And if its effect is getting people to use the resources, then the ads are doing what they were intended to do. So really tying the two together, find an advisor through referral, but do go through that process of checking the person and their firm's background. There's also a compliance mechanism within the company and the advisor's framework, but we can touch on that later.
Okay. I know the industry, the investment industry has changed a lot over the years. It's become much more educated and I guess investor friendly, but what can a person expect when meeting with an advisor?
Oh, another great question. Well, why don't we start with an introductory appointment? And we'll look at this from the investment side of the business. An introductory appointment is about getting to know each other. An advisor will want to gather information about a potential client, just like a potential client will want to know about what sort of services are offered by the advisor. A good advisor listens and gathers information about a person or family's current position and helps identify goals and aspirations going forward. This information gathering process can work as a starting point for an advisor educating a client about available options and then creating a financial pathway from current position to goal. Through a few visits or possibly a series of visits, an advisor can help a client understand him or herself as an investor. We're getting back to that investor versus a saver. So the advisor will help a client understand, and by using one or more diagnostic tools. And there are a few examples of different tools that an advisor will use, like an investment profile questionnaire. And what that does is it'll ask a number of questions, a potential client's age, timeline that they're going to invest for, the income that they earn, what kind of goals they have, and then some risk-related questions so that an advisor can start gauging, okay, well, how do we position this? We don't want to position somebody who's more of a saver as an investor, and likewise, we don't want to position somebody who's an investor as a saver. There's also different fact finders to prepare a needs analysis, and that's more financial related, and it'll take down all sorts of financial details. And then there's some that are just risk tolerance tests, and there are in-depth questions to gauge risk tolerance and appetite for risk. Like some examples of questions would be, if you're on a TV game show and you can choose one of the following, which would you take? $1,000 in cash and be done, or a 25% chance at winning $10,000? Questions like that, but lots of them so that an advisor can really gauge what sort of risk a person has tolerance or appetite for. Just like some people cannot take any risk with investing, others cannot invest without some degree of risk. It's interesting the way that works. So together, the advisor and client will complete one or more of these tools to aid the advisor in matching investments, and then they'll pick different components for a client's portfolio. Data gathered from these questionnaires is translated onto a Know Your Client document. You'll find the term KYC is used a lot in our industry, and that's Know Your Client. This KYC is really a set of parameters for the client's portfolio, and this is where supervision comes to the forefront. The investment choices must be suitable according to the KYC, or the Know Your Client parameters.
Wow. I mean, it's great to hear that things have tightened up over the years, but who does the supervision and how do they go about doing it?
Well, this is what happens behind the scenes. There are a few tiers of supervision. The first starts with someone in my position as a branch manager with a mutual fund dealer. Before an account can be set up, the KYC form is sent to me for review. So everything that happens between a client and an advisor gets boiled down and translated onto this KYC document. It gets sent to me for review and eventual approval. I check that the documents are complete and that the parameters are reasonable. And what I mean by that, if I would receive a new application for a 35-year-old who earns $100,000 a year with an intermediate investment knowledge, and they want an RSP fund, something that's going to be 20 or 30 years in investing time horizon, and it's indicated that half of the investments will be higher on the risk scale, I can likely approve that because of the client's long-term investment horizon and the strong income. But if I would receive a new application and a KYC for a senior with a lower income, modest assets, and low investment knowledge, and they want a short-term investment that will hold some high-risk investments, I will likely not approve that for opening unless there would be a reasonable explanation behind it. And so often we end up going back to find more context behind some investments that are placed. Every time there's a purchase, a redemption, or an adjustment on the account, the end result portfolio is weighed against that KYC to ensure that everything remains suitable according to the original plan. Does that make sense?
It does.
Okay, good. So these KYC parameters are updated a minimum of every 3 years to ensure that the advisor and the dealer are up to date with the client's overall situation. So there are a number of checks and balances here in place. So now all of our reviews are done electronically, which means we have great tools to assess suitability. Some KYC data that we consider during our reviews, age, income, time frame or investment horizon, assets and net worth, investment knowledge, and is the investment account required for current income needs? Mm-hmm. And these are just some of the areas. Again, it all comes down to the reasonableness. We ask the question, and we always face the question as advisors, would it be reasonable that a 28-year-old could have a small portion of a retirement account invested in a fund, for example, marijuana producers? Mm-hmm. Well, likely somebody who's 28, yes, they're probably up to date on that, and they have an appetite for investing in something with a little bit more growth potential. But how reasonable would it be that a 75-year-old widower, limited assets, would like to buy that same investment? Well, it's much less reasonable in that instance. And so that's why we have these compliance checks and balances. And again, as mentioned, these occur behind the scenes.
Right. Is it, if a 75-year-old was adamant about having some of their investment in a marijuana investment, would you allow it?
Well, you know what? It can happen. It can be allowed to happen. It just needs to be justified. And again, it comes down to looking at a number of different things. If it's 5% of somebody's overall investment, and if that person has more an intermediate investment knowledge, then it's more apt to, the likelihood of it being allowed is much better. If it is somebody who says that they acknowledge that they have a very limited investment knowledge, we would require the advisor to do a lot more education with the client before allowing for that.
Have you ever run across a situation where you've had to turn down an investment that the client was really adamant about having, and then the client went to another company?
Yes, that possibility exists. In this day and age, you and I and every Canadian can go online, and we can open a discount brokerage account, and we can buy just about any investment that we would want to buy. And so when it's done through a mutual fund dealer, there are certain rules and regulations that our regulator, the Mutual Fund Dealers Association, has in place, and there are certain rules that dealers will have in place, because we don't offload that liability to the client. It always remains our responsibility what the client is invested in. And so there are times that a dealer needs to save or protect a client from their own wishes.
Yeah. Well, sometimes a person is their own worst enemy.
It happens.
Yeah. And all this takes place behind the scenes.
Absolutely, it does. These compliance checks and balances typically occur without the client even knowing that they're going on. And that's a good thing. It's I think, a level of comfort that we have these checks and balances in place. Because then once the account is open and the investments are started, we get to sit back and watch the magic compound interest take over and hopefully get us to that position when our income-producing assets as investors can make our work optional.
Yeah, excellent. Rob, you have given us some really great information and advice. Thank you very much for being our guest today.
Thanks, Gary. Thank you for having me.
And thank you, audience, for listening in today. Until next time, my name is Gary Poyer. Have a fabulous day, and as Coach John Wooden would say, be sure to make today your masterpiece.
The views expressed here are those of the participants and not those of Customplan Financial Advisors Inc., its affiliates, or subsidiaries. This is not intended to serve as a complete analysis of every material fact regarding any company, industry, or security. This presentation may contain forward-looking statements. Investors are cautioned not to place undue reliance on such statements, as actual results could vary. This site and podcasts are for general information purposes only and does not constitute investment advice and is not intended as an endorsement of any specific investment product or service. Individual investors should consult with an investment professional about their personal situation. Past performance is not indicative of future results. If you are unsure about what is the best course of action for you in your financial planning, then we suggest you consult a fee-based independent financial advisor or get in touch with us to discuss your individual situation. Our phone number is 604-687-7773.